All right, so very good evening to you all. This is our last topic of this course, Global Financial Management. And the topic three, which I would be taking part discussing with you, it's the second part of your risk management topic. In the first topic, the first part, we did the currency forwards and the currency futures. And today I shall discuss with you currency options, how these options work in order to do the risk management by the companies. Unfortunately, we don't have time to discuss swaps, but maybe some other time when we meet, we can discuss swaps as well. So I shall be discussing with you the currency options, okay? You can go through the lecture objectives and all this stuff. So we discuss the options now. If you look at the currency forwards, one of the limitation of the currency forwards was that they are very rigid. Rigid means that when you sign the contract, and I often use this expression, you lock in with your counterparty, with the bank. It means that come what may, you cannot cancel the contract, even though something changes. Because you see what, you make a purchase from Belgium. You are in Belgium. You want to buy something from Australia, and you will be making the payment to this Australian exporter after 6 months. You'll be making the payment after 6 months. Many things can happen between 6 months. But in the forwards, the things are so static that even things change, that the life changes, there can be cancellation of the contract, amount can change, many things can change, but you cannot make a single change in the forward contract. So the currency forward was very flexible, very rigid. But on the contrary, the options, look at the word option. Even if you don't use the word option in the context of finance, if somebody asks you, hey, you have the option. Option means you can do this, you can do that, or you can do this, you cannot do that. So you have a choice. So in the currency option, you have a contract to buy or sell the foreign exchange in the future, specified currency, specified amount, specified rate of exchange, specified time period in the future. But it only gives you the right to exercise. There is no compulsion. No compulsion means you may exercise your right. You buy a right to buy Australian dollar from your bank or from the market, because you need to pay somebody in Australia in 6 months' time. Now, at the end of 6 months, you may use it, you may not use it. If things are favorable, you use it. Things are not favorable, don't use it. So it's like an option, flexibility. So the options are the most flexible tool, technique, strategy, instrument of foreign exchange risk management. Options are very popular because the modern financial world, especially the global finance, is highly volatile, okay? So option gives you extreme amount of flexibility. Options are traded in the exchanges, but till date, the biggest specialized exchange where these derivatives are traded is Chicago Board of Option Exchange. If you ever get a chance to visit SBOE website, you'll find very interesting information on that. Options used to be traded. In fact, Amsterdam Stock Exchange is well known for having the options way back, perhaps in 17th century, 17th or maybe early 18th century. But unfortunately, it couldn't have its what do you call it? it could not carry on its legacy popularity for a long time. So Chicago is the biggest stock exchange or the option exchange. Even though Amsterdam, Montreal, Philadelphia, they are very old and very famous option exchanges also. The purpose is very simple: hedging and speculation. Hedging means when you are basically did I do something silly? Yeah. Hedging is that you are going to you are a genuine company, genuine company in Belgium, and you place an order to an Australian exporter of technology. So it means that the technology will be transported, shipped from Australia to Belgium, and you will be making a payment. But in the future, and you are afraid that Australian dollar can appreciate against euro, and to avoid this problem, you are using the currency options. Okay, so here you use the word hedging. On the contrary, you may be having some surplus money with you to invest, speculate, and you think that, hey, it is highly likely that Australian dollar will go up, will rise against euro in the future. So what you do, you already buy the options. Okay, so it's both hedging and speculation. Normally the companies, financial institutions, and there are some specialized trading firms in the options. They are the big players. Even the stock exchanges are very famous. They also invest in the options. The standard options usually are the exchange traded. Now, again, it's very important. If you look at the forwards are clearly over-the-counter kind of contract. So it's between the company and the bank. Options can also be over-the-counter. So the option can be both market traded, the exchange traded, as well as over-the-counter. So one more flexibility of the option is that they can be both exchange traded as well as the over-the-counter traded. The forwards are OTC, the futures are exchange, but option can be both. All right, so yeah, but if you want to have the exchange traded, then definitely you need to open an account with your broker or agent so that you can see how much money you owe to the broker. Some words we use, I'm trying to get you familiar with the phraseology of options. Options are giving you the right to buy or sell something. And in this case, something is the currency, okay? Specified currency, specified rate of exchange, specified time period, and specified amount. I think that thing is missing. There's always an expiration date when the contract will mature. Strike price is the contract price, which means at the price at which you make an agreement that you will buy or sell the foreign exchange. One more phrase we use is that options can be American options or the European options. And believe me that America and Europe have nothing to do with their geographical locations at all. American option is the option which you can exercise either on the day of expiry of the contract or before. So you can exercise the contract anytime you wish. Remember the futures. In case of future, there is a deadline, but most of the times the contracts expire before the deadline. On the contrary, we have the forwards. The forwards only mature, the forwards only get exercised on the day of expiry or maturity. So those options which can be exercised on or before maturity are called American options. And those options which expire only and only and only on the day of maturity, the deadline, they are called European options. It means that American options have the element of futures, and the European options have the element of forwards. Okay, so American options are more flexible, the European options are less flexible or more rigid. Okay, yeah. Now we come back to the more open discussion about options. Options are of two types. The first option is called call option. Call, C-A-L-L. The call option is when you have the right but no obligation to buy a specified amount of foreign exchange at a specified rate of exchange for a specified time period. All right, that is called the currency call option. Specified currency, specified rate of exchange, specified amount, and specified expiry period. Okay, the strike price and the exercise price are the same words. Okay, so you might find in some book the contract price is written as exercise price or the strike price, but basically they are same. Okay, just synonyms. So in case of currency call option, you have the right but no obligation. You have the right, but you're not forced to do it. Okay, because that is the whole beauty of the word option. Option gives you the right but no obligation. Okay. So then the question is that who are you who will buy the currency call option? Well, you are an importer. You are in Belgium. You can be either hedging or speculating, but you will be buying something in the future. So if you are a hedger, if you are doing hedging, then it could be possible that you are importing something from Australia and you are going to pay your exporter who lives in Australia. You will be making a payment in the Australian dollar, and you are afraid that the Australian dollar can go up in the future against, up means appreciate against euro. And if you keep your position naked, you don't hedge it, it can cost you a fortune. Okay, so therefore you have the currency call option, but you only use the currency call option if it is favorable to you. All right, if it is not favorable to you, you don't use it. Let me give you an example. Listen carefully. Today, on 7th of January 2021, you sign a contract with a company in Australia that they would be providing you some artificial intelligence technology, and you will be making them a payment of 20 million Australian dollars. How much? 20 million Australian dollars. And let's say that the rate of exchange is 1 Australian dollar is equal to half of euro, so 0.50 euro. Okay. You are afraid that in 6 months' time, when you make a payment to this Australian company, the price can go up. So euro, the Australian dollar can become expensive. Okay. You go to the broker. Let's talk about that exchange traded option. You go to some exchange and you make a deal that you have the right to buy the option, the 1 Australian dollar in 6 months' time at 0.60 euro, so 60 cents. Okay, fine. So the 0.60 euro will be your strike price or the exercise price. Of course, to get this right, you make some premium also. You buy the premium, the fee, which is called the price of option or also the premium of option. Okay, it means that the spot rate is 0.50 euro for 1 Australian dollar, and the strike price or the contract price is 0.60. Now, just imagine after 6 months, when the contract matures, the market price after 6 months is $1 is equal to 70 cents, European cents. Was it worth buying the call option or not? It was worth. Good for you. You know why? Because the market price is 70 cents for $1, whereas you have the right. Now look what I highlighted. You have the right to buy $1 at 60 European cents. Good for you. So for every $1 you buy, you are saving 10 cents. But now see, after 6 months, the future market price, the spot price, is 55 cents. 55 cents. Whereas you have the contract which says that you can buy $1 for 60 cents. The market price in 6 months' time is 55 cents or 52 cents or 53 cents. But you have the contract price, which is called the exercise price or the strike price, to buy $1 for 60 cents. Bad for you. But you know what? You don't have any obligation to exercise the call option. You can just forget it. So if the situation, if the business proposition does not work in your favor, you are not compelled to exercise the option. You can just forget it. Of course, you would be losing the premium which you pay upfront, because remember that the premium you pay right now when you sign the contract, but the actual price of the actual strike price you will be paying, if you are paying, at the end of the period or before, whenever you think it's necessary. But you always pay the non-refundable option premium or the option price in the beginning. That is the only money you would be losing. Okay, so you are not obliged to fulfill the contract. Nobody would sue you. Nobody would be chasing you. Whereas if I take the extreme example of the forwards, you can never dare to run away from the contract. So the whole contract is an obligation upon you. Whereas there is no such obligation upon you in case of this. So that makes the options, that you have the option to use the contract, to exercise the contract. You have the right, but you don't have any obligation to. If it is not suitable to you, don't use it. Okay, that's the beauty of the option contract. That a currency call option. Remember, the call option gives the right. So you, and then I told you before that if you are having the right to buy something, then who are you? Well, in that case, you are an importer, basically. You need to buy something. So you need to pay somebody in the future. Okay. So remember, the currency call option is very interesting. Okay. How it works now. Now, this example is very important, and I want that you pay attention to it. Just imagine you are living in the US and you want to buy something from Great Britain, and you sign a contract either with a bank or you make a contract with the broker if it is a market traded contract, that hey, you know what, I will be buying £1 for 1.50 American dollars, so $1.50 American dollar for £1. To get this contract, you pay 2 cents. Right now, this 1.50 you will be paying, if paying, at the end of the contract or before, if it is an American option. But this premium or the price of the option, you pay right in the beginning of the contract. So you pay this, we use a phrase that you pay the premium upfront. Upfront means right in the beginning, you pay the premium. Okay. And let's see that now the time you are making a decision to exercise the option, you're considering that should you exercise the option or not. And remember that your strike price or the exercise price is 1.50 American dollar for £1. And in this example, we assume that your domestic currency is American dollar. Now see what happens. When you're considering to exercise the option and you find that the market price is 1.46, please tell me, when the market price is 1.46, whereas your contract price is 1.50, will you be exercising the option or not? Will you be exercising the option or not? No. Very well said. You will not exercise the option because in the contract, you need to pay 1.50 American dollars for one British pound, whereas you can buy British pound 1.46. So why should you pay 4 cents more? But then the problem is that when you don't exercise the option, you lose these 2 cents. Remember, these 2 cents you pay in the beginning when you sign the contract. In time 0 means when you sign the contract, then you pay the premium. And if you don't exercise the option, you cannot go to the bank or the broker and ask for your premium, refund of the premium you have paid. That is a bit bizarre. Nobody will give you any refund. It means that you are losing 2 cents. Okay? It means that when the market price is 1.46 and your strike price or the exercise price is 1.50, you don't exercise the option. When you don't exercise the option, you are only losing your option premium, 2 cents. Yeah? Okay. Now, I make a revision. The strike price is 1.50 and the market price is 1.48. I didn't write it here, but let's say that this is 1.48. Will you be exercising the option or not? Just write in the chat. At 1.48, will you be exercising the option or not? No, not again. Yes, very well said. You will not. Because the market is selling you at 1.48. The contract is 1.50. Therefore, the market is giving you 2 cents cheaper a British pound. Okay, then you don't exercise the contract. You have no obligation. Don't exercise the contract. But when you don't exercise the contract, you have to lose the premium of 2 cents, which you paid in the beginning. It will not come back to you. It means that at 1.46, at 1.48, at 1.47, the maximum loss which you can have is 2 cents. Isn't good that whatever is the price, when you make a decision not to exercise the option, you have the maximum loss of 2 cents, not more than that. It means that you know for sure that how much you can lose at the most. So your loss is limited. Your loss is not unlimited. And please don't confuse with this 2 cents. This 2 cents has nothing to do with the exercise or not exercise. Because this 2 cents you pay in the beginning, it will never come back to you. You exercise the option or you don't exercise the option, regardless of that, because you make a decision to exercise or not exercise at a later stage. Maybe after a month, 2 months, 3 months, 6 months, I don't know, many years, maybe sometimes. But this premium which you pay is right in the beginning when you sign the option contract. This is like a cat out of the bag. It will never come back to you. Okay, so when you are making a decision to exercise or don't exercise or not exercise, never, never, never bring this premium into your discussion, because this is paid, this is gone. You exercise or you don't exercise, this 2 cents is gone. So only compare the strike price with the market price. Okay, now I want to confuse you a bit more now. Your strike price is 1.50, the contract price or the exercise price. And on the day of decision making, the market price is also 1.50. The market price is also 1.50. Will you exercise the option or not? Again, write in chat. When the price is 1.46, 1.47, 1.48, 1.49, very clear, very clear. You will not exercise the option. But what about 1.50? When the market price is also 1.50 and the strike price is also 1.50. Will you or will you not? Did I get any comment? Well, you wrote neither. I would say either, which means that it doesn't make any difference. I'll tell you why. It doesn't matter. Yeah, you're right. It doesn't matter. It doesn't matter. Because if you are exercising the option, let's imagine that you are exercising the option. You pay 1.50 strike price, but in the beginning, you have already paid 2 cents. Whereas in the market, you could buy the same British pound for 1.50. But you paid 2 cents extra. It means you lose 2 cents. You pay extra 2 cents when you exercise the option. But if you don't exercise the option and you buy from the market, then forget about the 2 cents which you paid in the beginning. So either way, your loss is 2 cents. But here, one thing is for sure, that you are in a state of ambivalence, in a state of confusion, that should you buy from the broker or should you buy from the open market? Either way, you will be having a loss of 2 cents. It means that when you are comparing the strike price and the market price, and both are same, you are having the state of confusion. But when your strike price is more and the market price is less than the strike price, then you are very categorical that you will not exercise the option. Okay, I'm trying to add some more words, vocabulary to you. When you make a decision not to exercise the option because the market price is less and the strike price is more, we call it option out of the money. These words you will see in the future slides, but I thought that maybe it's a good idea that I discuss with you now. We call it out of the money. OTM means the option is out. If you are confused, you exercise or you don't exercise. And that's only possible when the strike price and the market price are same. Then we call it option at the money, ATM. The option is at the money, not the ATM machine, not that automatic telling machine, but ATM here means that option is at the money. So you exercise or you don't exercise makes no difference. Okay, but when the option, well, that word I will tell you later, but I want to continue with this example. The strike price is 1.50 and the market price is 1.52. Sorry, 1.51. I can't write it here, but let's say that here somewhere is 1.51. Will you exercise the option or not? The strike price is 1.50 and the market price is 1.51. Will you exercise the option or not? Write your answer in chat. Yes, you're right. Why so? When the market price is 1.51, you compare 1.51 with 1.50. And you compare that, the market price is 1 cent extra, 1 cent more expensive. So what you do then? You are buying from the broker at 1.50. And then your loss is not 2 cents, but your loss is 1 cent. If I draw 1.51 here and this line, so the loss is not 2 cents, but the loss is 1 cent. Because when you are exercising the option, you buy a pound for 1.50 plus you pay the 2 cent premium in the beginning. So altogether the cost is 1.52. But when you don't exercise the option, you pay 1.51 in the market plus this 2 cent is gone already. So 1 pound cost you 1.53. I repeat, when you exercise the option at 1.50, then you also add the cost of the premium. So it means 1 pound overall costs you $1.52. But when you don't exercise the option, then you are paying 1.51 for 1 pound plus 2 cents, which is non-refundable in the beginning. That money will never come back to you. So 1.51 plus 2 cents, $1.53 for 1 British pound. By exercising, you are paying altogether 1.52, but by not exercising, you are paying 1.53. So you compare it, you are saving 1 cent from your total loss. Your total loss would have been 2 cents, but now you're saving 1 cent. So otherwise your loss would have been 2 cents, but now your loss is 1 cent. So it means that even though there is a loss, but this loss is less than 2 cents. Because if you don't exercise the option, then your loss will be 2 cents. But by exercising the option, your loss, you still have a loss, but that loss is less than 2 cents. So when you have a choice of between more loss and less loss, obviously, it's like an example of whether you fall in the fire or in the fire pan. So you choose the one which pains you less. So obviously, you lose 1 cent, but if you don't exercise the option, you lose 2 cents. So you go for exercising the option. It means that you exercise the option. And when the market price is 1.52, then neither you gain anything nor you lose anything. It's a break-even point. But at a break-even point, you must exercise the option. Break-even means neither loss nor gain. But if you don't exercise the option, you would lose 2 cents. So therefore, you should use the option. You should exercise the option. And then anything above this, you must exercise. So if you look at the graph, if you look at the trajectory, you find that when the strike price is more and the market price is less than the strike price, you must not exercise the option. When you don't exercise the option, you lose these 2 cents straight away. But you will not lose more than 2 cents. So as I wrote the phrase here, your downside means your potential loss, and upside is potential gain. Your potential downside is limited 2 cents, equal to the premium of the option, of the price of the option. you will not lose more than 2 cents. So when the market price is less than the strike price, you don't exercise the option. The option is called out of the money, OTM, and your maximum loss is 2 cents. When the strike price 1.50 and the market price are same, then it doesn't matter because your loss is still 2 cents, but at least you are having this confusion. Okay, so when they both are same, then we use the phrase option is at the money, ATM. But when the market price is more than the strike price, you must exercise the option. You must exercise the option. When you exercise the option, you may have still loss, but that loss would be less than 2 cents loss. Or this loss may not even exist, break-even point. Or this loss is indefinitely positive. So if you look at this curved part of the line, you must exercise the option. And when you must exercise the option, we call it option is in the money, ITM. We always want our options to be in the money, ITM, because that would give us potential benefit. So I repeat, look at the cursor. Option is OTM, out of the money. Well, it's not a good situation because you have to lose the premium. Option is at the money, 1 point, the corner, the angular point. Well, you exercise or don't exercise, loss is same. And then this is the nice part. The option is in the money, where the option, where you being a buyer of call option, which gives you right to buy, but not obligation of some specified currency, specified amount, specified rate of exchange, specified time period. This would be good for you. And then it's called option is in the money, ITM. So option ITM, ATM, and OTM, out of the money, at the money, and in the money. We want our option to be in the money. We always wish our option to be in the money. But the one good thing, being a buyer of the call option, is that there is no restriction of your gain. So just imagine that the market price of a pound when you are making a decision to exercise the option is 1 pound is equal to 10 American dollars, 10. But then you have the right to buy at 1.50, and then you buy something at 1.50, sell in the market for 10. If you're a speculator. And look at your gain can be huge. But if you don't exercise the option, then you will be not having unlimited loss. You have the maximum loss equal to 2 cents. Okay. But remember, who are you in this case? You are the buyer of call option. But if you're a buyer of the call option, there should be some seller of the call option also. The seller of the call option is called the writer of the call option, and that is his payoff. Can you see this graph? This graph and this graph, can you compare? This graph, this is for the buyer of call option, and this is for the seller of the call option. If the option is an exchange traded, then this is the situation for the broker. And if the option is bought from the OTM, it means, OTC, over the counter, not OTM, OTC, from the bank, then the bank is the seller of the option. Seller is also called a writer of the option. And you can see that the situation is just opposite. So this is for the buyer of call option, and this is for the seller of the call option. So it's just a mirror image, you can see. Explanation is same. the writer or the seller of the call option only gain when the buyer does not exercise. So the buyer lose 2 cents. So that is the maximum gain of the seller of the call option. And when the buyer is having the unlimited potential to go up, the seller have the unlimited potential to the losses. So you can see that situation is just opposite. Being a buyer of the call option, you would be wishing your option to be in the money. Being a seller of the call option, you will be wishing for the option to be out of the money, because only then you can gain. You mean the seller can gain. So it's like a seesaw. Seesaw means one person goes up, the other goes down. So it's like either you gain or this, you mean either the buyer gain or the seller of the option gain. It's not a win-win situation. It has to be like more like a zero-sum game in many cases, because when the buyer gains, the seller lose, and when the buyer lose, then the seller gain. But the philosophical difference between this picture and this picture is that in this picture, the loss is limited, but the gain can be unlimited. But here, for the seller, the gain is limited, not more than 2 cents. The seller would never get more than 2 cents as a gain, but his or her loss can be unlimited. So it means that in case of the call option, if you compare the potential, notional, theoretical risk, the situation of the seller of the call option is more risky than the buyer of. And the question is that, why do people sell the options? Well, because these are the big banks. You may be having, as a buyer, you may have one contract per 6 months, but these people who are the sellers, they can be having 60 contract or 100 contract in one day. So they may lose on some, but they may gain on others. So that basically evens out the situation. So even though this seems to be limited 2 cents gain, but when they are gaining on many contracts, then they may not be in such a advantageous. So they have economies of scale, advantage. So that is why don't worry too much about this philosophical imbalance, which is in favor of the buyer of the call option and against the seller of the call option. Okay, so this is how we are treating. And these words, I think I told already. A call option is in the money if the market futures spot rate is more than the strike price. Being a buyer of the call option, you would love to be in this situation. At the money when both are same and you are having a neutral. So you exercise, don't exercise, it doesn't matter. Out of the money is when when the spot price, the future spot price is less than, spot mean the market price is below the strike price. And then you don't exercise the option. It's not a good thing for the buyer of the call option, but it's definitely good for the seller of the call option, because he would be getting the premium, which he will not refund you back. And that is the only gain the seller of the call option has. Okay, so I give you quick break for 5 minutes and recall everything that we discussed, and then we would do an example to explain. So I give you a few minutes break, but basically it's not a break. I want you to recall everything what I discussed in the previous slides, and you guys can ask me if you have any questions. Okay. Okay, so we do one example now with the call option contracts. The wording is, a US firm is bidding a contract in Canada. And the contract is that it could be possible that there is a factory in Canada which a US firm is planning to bid. Bid means to buy. And the price of this factory or the project is 200,000 Canadian dollars. And when you bid, you have a anonymous bid. You don't know until next 3 months if the bid is accepted or not. You don't know it. Okay. It means that if you are able to buy the factory, you would be needing to pay 200,000 Canadian dollars. It means that you need to have 200,000 Canadian dollars now. It means we are talking about the currency call option. In this case, you buy 2 option contracts. And I put it here, why? Because if you look at the future contract slides, there are certain standard sizes of the contract. And for the Canadian dollar, it was 100,000 standard size of one contract. Nothing more, nothing less. It's indivisible. It's like a package of 100,000 because you need 200,000. Therefore, you need 2 option contracts. Okay. And what you do, you agree with the bank or the broker that the exercise price is 1 Canadian dollar is equal to 0.855 American dollar. And it's a direct quote. I just wrote here to confuse you. It's a direct quote. And the premium is for each Canadian dollar, the option premium is 0.1662 American dollar. It means that even though this would be decided that whether you buy the Canadian factory or not after 3 months, but if you want to buy the currency call option contract, you need to pay 33,240 American dollars to the bank if you want to buy it from the bank. How? Because for 1 Canadian dollar, the premium is 0.1662. And if you want to buy 200,000 Canadian dollars, then if you multiply them, it comes to be 33,240 American dollars. And why I split 200,000 into 2 times 100,000? It means that the standard contract is 100,000, but because you need 200,000, so you multiply by 2. It means you need to buy 2 bundles of Canadian call option contract. Now, if you remember this example, when you are a buyer of call option, the maximum loss is the option price or the option premium. It means that in this example, the maximum loss which the American company can have is 33,240. That's the maximum loss which the Canadian company can, the US company can have in this whole situation. If the bid is successful, it means that the Canadian company writes you a letter and says that I'm happy to announce you that you are the buyer of this Canadian factory. Okay, please pay us 200,000 Canadian dollars and own the company. Okay, when you buy this 200,000 Canadian dollars via options, then how much money you give? You give this is your exercise price. So you multiply 0.855 American dollar with 200,000 Canadian dollars. So that makes it 171,000, so 171,000 American dollars, plus you pay the premium. Also remember the premium, otherwise this contract will not be signed. So altogether, if I add the exercise price plus the premium, total premium, your total cost is 204,240. Okay. But if you didn't sign this contract and you think, okay, we will buy 200,000 Canadian dollars from the market, and when you are going to pay them, the Canadian factory owner, on that day, the 1 Canadian dollar is selling for 1.275 American dollar. It would cost you a huge amount of money. It means that this price would have been much, 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 much more than this It means that the option is in the money. In the money means it's cheaper to exercise the option than not to exercise the option. Remember the in the money option? In the money option is when the future market spot rate is more than the strike price. And here you can see that the future spot rate is more than the strike price. Good for you. Congratulations. You have saved 50,760 American dollars. So the option is in the money for you. Of course, I can play with the numbers and then we can decide that if the option is in the money or out of the money. So yeah. Okay, so we carry on with this example. If the option is, if the future spot rate was this, 0.775, 0.775 or 0.9, 0.775. Now 0.775 is below the 0.855, which, yeah, it means when it's 0.775, the option is out of the money. Out of the money means you don't exercise the option because it's less than the strike price. In that case, your loss would be how much? Your loss is always equal to the premium. And how much is the premium you pay? 33,240 American dollars. So your maximum loss is this much. Okay, so, but now there's a little bit of trick. What if, remember the question? That the US company was bidding for this company and the bid was successful in this case. But what if the bid is unsuccessful? What if the bid is rejected? Well, no problem, nothing to worry, nothing to worry. You have the right to buy 200,000 Canadian dollars at this price, plus the premium. And if your bid is rejected, you still have the right to buy 200,000 Canadian dollars at this price, plus the premium. And if in the market, if the market price is this, good for you. You can buy the 200,000 Canadian dollars by investing this amount of money and then selling them at this price. And thus you can still make a gain of 50,760. So whether your contract is accepted or your contract is rejected, if the future spot rate is more than the strike price / exercise price, you will be gaining something, or at least you will be able to recover the price of your some of the options premium. It's good for you. The option will be in the money. Of course, when the situation is this, it's bad for you because you are not only losing the contract, but you're also losing a lot of money in the option premium. But remember that when you are a buyer of call option, your maximum loss is, in this question, your maximum loss is 33,240 because that is the premium. And we have seen in the previous slides that the maximum loss which the buyer of the option has, is the premium. So that's the maximum loss you have. Okay. Any question, comment? Okay. Well, if you don't have, then we move on. The next kind of options that we have are called currency put option. Put option. In the currency call option, if you remember the example I gave you, you were an importer. You were going to buy something. You were going to pay the foreign exchange. But in the put option, you are an exporter who would be earning something from abroad. Maybe you're in Belgium and you are selling something to Canada, and this Canadian company would pay you after 1 year, but they would pay you in the Canadian dollars after 1 year. So you are afraid that the Canadian dollar can depreciate against euro. So then what you do, you buy the put option either from the broker or the bank, depending upon whether it's OTC or the exchange traded, and that would give you right but not obligation to sell Canadian dollar, which means specified currency, specified amount, specified rate of exchange, and for the specified time period in the future. So the option, the put option gives you the right to sell something, but it's not an obligation. It's not an obligation. Okay, and once again, the put option could be used by the hedging or the speculation activities. And once again, those options could be in the money, at the money, and out of the money. When you exercise the put option, it means you use it. It's in the money. When you are in a state of confusion, because either way the loss is same, then it's at the money, and when you must not exercise the option, which is a very unfavorable and disappointing situation, then it's called option as out of the money option. But in this case, the values are different. In case of call option, the spot rate is more than strike price in the money, but because it's an opposite put option, this time you are selling something, so the sign is opposite. Okay. In case of call option, the option is out of the money when the spot rate is less than the strike price. But in case of put option, the option is out of the money when the spot rate is more than the strike price. Okay. Market is giving you more money than the broker gives you, so that way. And here is when you are a buyer of a put option, then this is your payoff. This is your payoff. It means that, let's say, you are living in the USA and you are selling something to Britain, UK, and you are afraid that the pound can depreciate, go down against American dollar, which is your domestic currency. And you go to the broker or the bank and you buy the put option. Put option gives you the right to sell something, but no obligation, no strings attached. And the strike price or the exercise price is £1 equal to 1.50. It means that you give £1 to the bank and the bank will give you 1.50. But then when you sign the contract, you already pay 3 cents to the broker or the bank, whatever the contract is. And that's called put option premium or the price. Premium and the price of the option are same thing. Now, the time of judgment comes, the time of decision making comes. The market price is 1.46. It means the market is giving you $1.46 for every £1 you sell, but the broker is giving you 1.50. Hey, you should exercise the option. You must exercise the option. Okay, it means that 1.50 minus 1.46, you earn 4 cents. But actually you earn 1 cent because 3 cents is the premium you pay in the beginning. That's your cost anyway. So 4 cents is a difference here, but because you pay the 3 cents when you bought this contract, so basically you're saving 1 cent here. The option is in the money. If it is less than 1.46, even better for you. Even better for you. Let's say 1.40 is the market price. Well, the market gives you 1.40, the broker gives you 1.50. So you earn 10 cents minus 3, 7. Just not bad. It means lower the strike price. No. Lower the future spot price in comparison to the strike price. More the option is in the money. Which option? Put option is in the money. And once again, if the price of the contract is 1.50, then either way, gain or loss makes no difference. So you are losing 3 cents anyways. And then if the market price is 1.54, 1.55, more than strike price, then you must not exercise the option, because then market is giving you a higher amount than the broker can give you. It means you don't exercise the option. When you don't exercise the option, then forget the 3 cents which you paid in the beginning. Forget them. They will never come back to you. It means that then you lose these 3 cents. And you can see that here. You will not lose more than 3 cents. 3 cents is the maximum loss which you have. It means your loss is limited. But in this case, your upside potential is also limited, but your upside potential is more than the downside loss, basically. Okay. Yeah. So this is the payout. This is the payoff, not payout. This is the pay. Sorry. This is the payoff when you buy the put option. And put option gives you the right, but not obligation to sell a specified currency, specified amount of it, at a specified rate of exchange, and for the specified time period. Option is in the money, option is at the money, and option is out of the money. It's very unfortunate when the option is out of the money. And if you are having a look, now you know that in case of call option, when we had the payoff of the buyer of the option, and then we have a payoff for the seller of the option, it was just opposite, what we call as a mirror image, mirror reflection. And this is same is true here also. This is how the situation for the writer or the seller of the put option would look like. When the option is out of the money for the buyer, this is when he gains. And when option is in the money for the buyer, this is where the seller of the option is losing the money. So if you know the payoff of the buyer, it's very easy to make for the seller. Just reverse the image. Okay. Yeah. So I give you 5 minutes once again to recall the put option slides, and then we will do the example. Okay. So very quickly, you have a look at the put option. If you know the call option, then learning put option is much easier. It doesn't take so much of time, because then you are aware of these words: in the money, at the money, out of the money, over the counter, exchange traded, strike price, exercise price, premium. These words then look more familiar. The only difference would be that in case of call option, you have the right but not obligation to buy something. Whereas in the put option, you have the right but not obligation to sell something. So just see it differently, but those technicalities, they remain same. So I give you 5 minutes to have a quick recall of the discussion we had so far. Okay, so after we have some familiarization of the put option and its intricacies, we have an example. And here we will be using the currency put option for hedging, right? And here the question is, a US firm receives a bid from a Canadian contracting company. It means that this time the Canadian company is planning to buy a factory in the US. You as a student, you can assume that your domestic currency is American dollar, and the Canadian company is planning to buy your company. And if they are successful, they would pay you 200,000 Canadian dollars. So in this case, they would be paying in the Canadian dollars to you. So it means that, and this decision would be taken after 3 months. Okay, so it could be possible that the Canadian dollar can depreciate against American dollar, and you are afraid of it. So then the right option is to buy the put option, and you either go to the broker or go to you're buying two put option contracts, which means that you have this. What I'm doing, something I miss out the cursor, and it's crazy. Two contracts. Two, because the standard contract is 100,000, and because in this case the money involved is 200,000, so you buy the two. And let's say that you have a contract that you will be getting for each Canadian dollar, you will be getting 0.895 American dollar. Okay, and this time you have because you are going to hedge yourself, so no free lunches. So you need to buy the put option, okay? And when you buy the put option, or you buy the premium, you pay the premium, or you pay the price of the put option. The price is for every one Canadian dollar, you pay American dollar 0.006. And when you multiply 0.006 for 200,000, it comes out to be 1.20 American $20. It means that the maximum premium you pay is basically $120, which is very cheap. And it means that the maximum loss you can have is 1.20, because you will not lose as a buyer of the put option. You will not lose more than $1.20 because that is a total premium you pay. And if you see the pictures, your maximum loss is the premium. So you will not lose more than the total premium, which is 1.20. And just imagine that if your bid is successful, okay, you are going to sell your company to the Canadian company, and they would be paying you 200,000. And let's say that when they make this payment on that day, the one Canadian dollar is selling for 0.850 American dollars. So what happens in this case? So in this case, the market price, the future spot rate, is less than the strike price. It's good for you. And if it happens, then the option is in the money. Remember, the option is in the money if the future spot rate is less than the strike price. Your strike price is, I think, 0.895, and the spot rate is 8.50. So yeah, something like, yeah. So it's good for you. So you make money. If you were selling, if you were unhedged, or what we use as a naked strategy, you would have got 170,000 American dollars by selling a company worth 200,000 Canadian dollars. But if you are using the put option, then you get not 850, but you get 895 multiplied by 200,000 and minus 1.20. Remember, this option premium you pay because you got this insurance. The one who gets insured pays the premium also. So it means that when you get hedged, you get 178,880 American dollars in the domestic currency. It means that altogether you are earning 8,880 American dollars more than what you would have got if you were uninsured or having the naked acquisition, what we use as a phrase. Okay, and then you can try these different exchange rates and stuff like that. But the basic idea is that you always compare if the option is in the money, out of the money, or at the money. So in this case, the option is definitely in the money. But remember that the criteria of in the money, at the money, and out of the money is different for the call option and for the put option. In the call option, you buy the right to buy something, but no obligation. In the put option, you buy the right to sell something, but no obligation. So therefore, the understanding should be totally different. Okay, just to let you know that these options are very important when you are cross-border mergers and acquisitions. When the companies are being bought or sold across the borders, which means when there are multiple currencies are involved. In that case, the call and put options are very frequently used. Yeah. But I told you that normally we use options more if there are bigger amounts, if the fluctuation is more, okay, and if we want to have the more flexibility, because and for this add-on functions or these better functions, which makes options qualitatively better than the other comparative derivative contracts, we have to pay more service fee also. And the service fee in this case is definitely the option premium or the option price. Premium and the price are same thing. Okay. Yeah. So if you get better services through options, you also pay more price as well. So this is everything for now. And this is all about the options basically. So a quick recall, we studied the forwards, futures, and then options, which involve the elements of both options and the futures and the forwards. But definitely they're far more flexible and far more user-friendly, than the forwards at least. Okay, so this is all about the currency options. And thank you so much. And please get back to me if you have any questions and any comment to make.